Well, as global economies reel from the consequences of prolonged geopolitical tensions, supply chain disruptions, and a shifting interest rate landscape, the Central Bank of Nigeria has doubled down on its inflation fighting strategy. At the July 2025 Monetary Policy Committee meeting, the Apex Bank chose to hold all key monetary parameters steady. Yes, we've stayed on this for some time, but today we would delve a little because in that report you see that it is signaling a clear intent to maintain tight policy until price stability is firmly entrenched. The July meeting marked the third consecutive hold of the monetary policy rate, which has remained at 27.5% since November 2024. Now, the asymmetric corridor was kept at plus 500 and minus 100 basis points, while the cash reserve ratio for deposit, money banks and merchant banks stayed at 50% and 16% respectively. Liquidity ratio also remained at 30%. Now, this policy hold comes at a time when headline inflation has shown signs of deceleration. According to the National Bureau of Statistics, annual inflation dropped to 22.22% in June 2025 from 22.97% in May, marking the third consecutive monthly decline. However, the monthly inflation rate rose to 1.68% in June from 1.53% in May, indicating persistent price pressures in the short term. Nabila Mohammed is my guest. She's an investment analyst. She works with Chapel Hill Denham. Nabila, good afternoon. Thank you so very much for being on the program.
Thank you for having me. Good afternoon.
Yeah, it's good to really have you on the show this afternoon. Well, Nabila, I think I should ask first, with the worries of a bit of month-on-month increase in inflation, which we saw in the month of June, I think I am worried, and I think maybe that's part of the reason why there was no shift by the Monetary Policy Committee. What do you think surrounded, or what do you think took center stage at that gathering, that meeting, that made sure at the end of the day they still had to hold all rates and parameters unchanged?
As you rightly said, I think what they really looked at was the fact that month-on-month inflation pressures resurfaced, and that alone is something that we should really be paying attention to. The reason is because the year-on-year inflation obviously reflects the impact of the rebasing that happened with the consumer price index earlier this year. So if we're looking at that alone, we'll be experiencing some level of disinflation, which is just a general rise in price levels at a much more slower pace than it did previously. But the month-on-month inflation calculation is where we would really see what is happening right now. And truly pressures persisted across all the indices. And it just supports the committee's stance to really just remain and hold rates across all the parameters steady, in order to experience more of this month-on-month figures and see how they pan out over the coming months. Yes, there are other things that they consider. They consider the stability in FX. They also consider the fact that global tensions still persist. Let me remind everyone that truly the impact of the increase in tariffs that started in the second quarter of 2025 is right now that we're beginning to see that impact on global inflation, because we've seen that global disinflation has slowed. And as a result of this increases in tariffs and how it is impacting not just different regions across the world, there's definitely going to be some level of ripple effect that it will have. So it's really not that time yet for the committee to say, okay, we can start to cut because we're seeing year-on-year inflation. There are a lot of other considerations that they have to look at for them to make that decision. It's going to be a big one if they had decided to, start to cut or turn dovish when they are still seeing that there are pressures that can drive underlying inflation and bring about another resurgence across board, not just within Nigeria. There are pressures within Nigeria, there are pressures outside Nigeria. So all those factors were really considered by the committee before they decided to remain hawkish, remain tight by leaving rates unchanged.
I'll follow up with the fact that the likes of the Manufacturers Association of Nigeria have come up, also the Lagos Chamber of Commerce and Industry, have come up to ask questions that if we are lending at above 30%, I don't know what kind of business anyone could run in Nigeria at this time that you will make profit. Yes, I already see that smile on your face, but you know that's the truth. So what sort of business are we going to run at this time if we're going to get profit and we are borrowing at above 30%? So it's not looking good for business people at this time. So are we caught in between the devil and the deep blue sea? I don't know. I'm stuck here. But where are we? Where do we find ourselves?
So, truth be told, their concerns are really valid because these manufacturers need money to make money. Let me just put it as simple as that. But the truth of the matter is that even the committee members agree that this whole remaining tight and maintaining a tight stance comes at a cost. But as you rightly said, it's a case of being caught between the devil and the TVC. The committee had to pick between trying to rein in inflation and trying to improve economic the whole ambience in terms of borrowing for the manufacturers. But then it's also the onus on the fiscal side of things to make sure that the environment in which these manufacturers are operating in terms of all the favorable policies across sectors that help them to improve their output are really implemented for them to be able to, sustain their levels. Yes, we did see that there was a complaint or there was a call by the manufacturers to the committee members and MPC members to cut interest rates. But then the optics are not looking like they should be cutting interest rates right now. So it is now left to other things like ensuring FX stability, ensuring security, ensuring a number of other infrastructural developments that are being in place to help the manufacturers grow and improve in terms of the output that come from them. But that cannot be right now. So we just have to make do with what we have in order to get what we want in the long term.
Indeed, this is not the best times to be a CBN governor, I must say. Not just here, even what is happening in the U.S. You see what Trump and Jerome Powell, what they're going through, the back and forth with regards to dropping interest rates and all of that. But let's stay back home again and look at external sector stability. We see our external reserves doing pretty well, above $40 billion US at this time. That for me is above 9 months of imports. A bit of stability in our economy if we are to look at this. But there is still this report showing that there are some targeted interventions. Yes, let me use that word. To maintain the foreign exchange stability that we've seen in recent times, quoting about $4.1 billion injected into the foreign exchange market. Now, do you think that we will continue to do this for that sustainability? How does that come to you surrounding that market in its totality?
So in terms of FX, yes, I agree we've had stability, but we've also had a lot of interventions from the CBN just to make sure that the FX rate remains stable in the market. But then there are other underlying factors that seem to have improved in terms of just looking at the FX market alone. We've seen that the inflows have improved, especially from foreign portfolio investors, and this has sort of supported the stability that we're seeing. And we've also had news flows from the government saying that we've had increased export earnings from crude oil sales that the country has made over the first 6-7 months of the year. We've also seen, as you mentioned, an aggressive reduction in terms of imports that have been recorded over this month. So some of these things have really supported, but are we out of the woods yet? The answer is no. We still have a lot more to do because some of these things that have been achieved so far in FX market are really short term because of how we've seen, yes, FPIs have increased. If they wake up tomorrow and decide to take their money, there's no one that would just want to hold them back using force, because after all, it is their money to take back and they can decide whether or not to do so. So these are short-term measures. So we are looking more long-term. There are a lot of other sectors that we can really develop and improve in terms of export so that we can earn more, not just from crude oil. In fact, if we improve the oil refining capacity is already there, but if we improve in terms of exporting refined products and not just exporting the crude oil itself, we would definitely see some level of increase in terms of export earnings. So there are other sectors that we can do more in terms of the entire, just looking at the general economy at large and how much we can rake in from that when we decide to export the products that we churn out from those sectors. So FX stability, yes, short term, we're seeing that. In the long term, there's a lot more that needs to be done. And that will not necessarily come, of course, from the MPC, that's from the MPC members or from the CBN itself in terms of intervention. It will also come from other structural repairs or structural investments that can be put in place to support the FX stability in the long term. So it's a mix of both, really. But we've seen some improvement as a result of these short-term measures that have been, achieved so far.
Interesting stuff. Now, boosting revenue sources, the ongoing recapitalization process or program of the banks, according to the Apex Bank speech on that very day, 8 banks have succeeded to meet up with the requirements, and many say that's a bit of, good news. We could say there's some good news coming in from the financial sector, but generally, what do you make about that? And talking about confidence in our banking system.
So, I mean, with all the talk about recapitalization that sprung up, over a year ago, and how we've seen the improvement in terms of flows that are coming into the capital market. Yes, I would say it is really largely the fact that this current CBN administration, they are trying to make sure that our financial system is strong, is well, equipped to absorb whatever shocks that happen, even in the future. The last time we did this recapitalization is 2005, if I'm not mistaken, and that's a long time ago, and so much has happened to the economy. We've grown, we've expanded, we've even experienced recession, we've experienced a lot of ups and downs over that long period. So this recapitalization exercise helps to prepare the financial system to be more, efficient, to carry out their responsibility of lending to sectors that are critical to the overall economic development. I would say it is a good thing, and it has indeed put our financial system, our banking system in that light, not just in Nigeria, even outside Nigeria. We've seen increased participation because of how the recapitalization process has been done in terms of making it available to retail investors. We've seen a lot of participation in the market, something that we initially used to see foreign participation take up like half of the equity market performance or equity market volumes and value, but we're now seeing more retail players in there, and because of this whole recapitalization drive. So it is a good thing. It has created not just that market for improved investors participation, it has also put us in that light. And aside that, all the other supporting policies in terms of cleaning up the books of the bank with the whole forbearance exercise that is going on, just shows that indeed this current CBN administration is trying to make sure that the entire banking system is really under the right parameters to carry out their responsibility without any hassle at all.
I think I agree with that. Under the right parameters, of course, to carry out their duties. Now, let's take a dive into the rebased GDP figures. We waited so much for these figures. Everyone across the business community, investment analysts like you, everyone, we're waiting for those figures to come up. But for me, I'm particular about some sectors like the real estate sector performed so very well. Trade, crop production, telecommunications. I think these were the sectors that led the pack. How do they come to you? What do you make of the entirety of that rebased GDP as released by the NBS? What message does it send? really?
So it sends one simple message, and that is that the Nigerian economy is actually bigger than we thought it was in the previous, data that we had out there in terms of the whole output of the economy that we had out there. I mean, we're coming from around 270 trillion to as high as 372 trillion at the end of 2024. So that alone shows us that indeed there were some sectors that were either underreported or were not even well captured at all in the previous data. So this is the key message with the data that was released, that Nigeria is actually bigger than what we thought it was. In terms of specific sectors, yes, we did see that the real estate sector now is like the third contributor in terms of contribution to GDP. And that is largely because of what I earlier said, which is that some of the activities in that sector were not previously captured. So because they are now well captured, because they are now that sector is now well covered, we are now seeing some level of we're now seeing the true side of that sector, and that is why we are now seeing it as the third in terms of contribution to GDP. Yes, we still have the crop production topping that chart, and instead of crude oil that used to be the third is now like the fifth, and real estate is now the third. So it's basically just capturing up the data that made it that big. And we also saw that in terms of growth for 2024, that's the full year, so it's at 3.4%. That's what it was previously. So all these things just speaks to the fact that we are now capturing a lot of things. And they mentioned that in the data that was released, they also mentioned that the informal sector now accounts for 42.5%. And just looking at the breakdown, we also saw that there are some sectors that the large part of it is under the informal sector, and that's under agri. And we can all understand why we're seeing a whole over 90% under informal for agricultural activities, because most of the activities that go on there are not necessarily formalized, and that is why we saw that. But overall, from 41% in terms of informal contribution to GDP has moved to 42%. So that is just really the key message. We are now capturing some sectors or across sectors, we're capturing more information, more data based on what was released by FBS.
From an investment analyst point of view, let's wrap this up. What are you expecting? What's the outlook for the investment environment? Do you think that Nigeria is really open for investment? Considering these figures, considering what is expected, IMF just revised also GDP growth rate, and so that also looks like a very good one. So what are you expecting? What's the outlook for the entire investment circle?
So if we are going to look ahead in terms of sectors, there are key sectors that I believe investors should really be paying attention to and how they perform over the coming quarters as well as coming years. The information and communication, that's the ICT space, is a sector that has that potential to do a lot more. We have very high subscriber base. We have very strong demand for data. We've seen it increase over this short period, that's just this year. We also have the growing availability of affordable smartphones that are not necessarily expensive for you and I to use and have access to this data. So that sector is somewhere that I believe if we see improved investment in there, we definitely see it contribute significantly to the real GDP growth of the entire country. Another sector that we should also be able to improve investment in is the agricultural sector. I mean, it still contributes a large chunk to the entire GDP as a whole, but yet it is growing at a very sluggish rate. So if we can improve the investments that we have in there, improvement around supply chain, improvement around road network, improvement around insecurity, and not depending on our planting kind of activity in Nigeria is more or less like season dependent. We are not a country that plants all year round because we do not have those facilities in place, whether it's irrigation, whether it's good road network. We don't have those facilities in place to ensure an all year round planting season. So that as well needs to be addressed if we want to see a much stronger growth recorded by the agricultural sector. That is one area I believe investors should also look into. Then there is also the area of manufacturing. Yes, we understand that elevated interest rate is sort of impeding the performance of these manufacturers, but this high interest rate, if disinflation, of course, is sustained, not just on year-on-year basis, but on a month-on-month basis as well, we definitely see it come down. But there are other factors which I earlier made mention of that are structural, that are not necessarily under the control of the monetary policy committee, and would have to be the fiscal authorities that cater to those things. If those structural investments are made in across power, across infrastructure generally, we should see the manufacturing sector also pick up and support the overall economic growth for Nigeria. So these are three areas I believe we can look at going forward.
Great stuff. Nabila Mohammed is an investment analyst with Chapel Hill Denham. Thank you so much. Do enjoy the rest of your day. We appreciate it.
Thank you for having me.
All right then.